If you believe taxation concludes when life ends, you may want to reconsider that assumption. In Canada, the year 2026 is emerging as a critical turning point for families who presume that when someone passes away, their accumulated wealth simply transfers quietly to the next generation. The reality presents a starkly different picture. Although Canada does not impose a traditional inheritance tax in the manner observed in certain other nations, the existing taxation framework can generate substantial financial obligations at the time of death. Without adequate preparation, that obligation must be satisfied before children, spouses, or designated beneficiaries receive any portion of the estate. This analysis breaks down the essential information clearly and methodically. There is no cause for alarm or exaggeration. These are simply the facts that every Canadian needs to understand. When examining estate taxation in Canada, confusion carries a significant financial cost. The most fundamental concept requiring comprehension involves how the Canada Revenue Agency treats the moment of death. When an individual passes away in Canada, the Federal Tax Authority treats that moment as though the deceased sold virtually every asset they owned at fair market value on the day preceding death. Tax professionals refer to this as a deemed disposition. Whether or not any actual sale occurred is irrelevant. For taxation purposes, the government treats the situation as if a sale transpired. Consider an example where an individual purchased shares several decades ago for $20,000, and at the time of death, those shares have appreciated to $200,000. That $180,000 increase constitutes a capital gain. Despite no actual cash changing hands, that gain must be reported on the final tax return. The estate bears responsibility for paying the applicable tax before any remaining assets can be distributed to beneficiaries. For numerous Canadians, particularly seniors who acquired homes, vacation properties, or investment portfolios decades ago, the appreciation in value has been considerable. That accumulated growth represents potential tax exposure that many families have not adequately considered. The approaching year of 2026 carries particular significance in this context. Following recent federal budget proposals, the capital gains inclusion rate is undergoing modification for larger gains. Historically, only 50% of any capital gain was included as taxable income. Under the proposed framework, for individual taxpayers, capital gains exceeding a specified annual threshold become subject to a higher inclusion rate of 2/3. While complete implementation details continue developing, the policy direction remains evident. Larger gains translate to a larger portion of that gain becoming taxable income. This development matters significantly because death frequently triggers substantial capital gains simultaneously. Rental properties, vacation homes, non-registered investment portfolios, and private company shares can all generate considerable gains. When those gains exceed the established threshold, a greater percentage becomes taxable. This does not mean the government claims 2/3 of the gain outright. Rather, 2/3 of the gain enters the income calculation and faces taxation at the deceased's marginal rate. For estates already pushed into elevated income brackets during the year of death, the resulting tax obligation can prove substantial. The family residence deserves particular attention in this discussion. Many Canadians hold the belief that their primary home will always transfer tax-free upon death. This assumption is partially accurate. Canada maintains what is known as the principal residence exemption. If a property qualifies entirely as the principal residence for every year of ownership, the capital gain may be sheltered from taxation. However, complications emerge when multiple properties exist, when years of non-residency have occurred, when rental use has taken place, or when partial designation issues arise. A cottage or rental property does not qualify under the same provisions. Those gains face full exposure to capital gains tax at the time of death. Registered accounts demand special consideration in estate planning discussions. Registered retirement savings plans and registered retirement income funds require careful attention. When an individual dies without a surviving spouse or qualifying dependent beneficiary, the entire fair market value of the registered retirement savings plan or registered retirement income fund must be included as income on the final tax return. Not 50%, not 2/3, the complete amount. That inclusion can push the estate into the highest marginal tax bracket applicable in that particular province. A registered retirement savings plan valued at $400,000 added to other income during the year of death can easily generate tax obligations reaching six figures, depending on provincial rates. Families frequently express shock upon discovering that a substantial portion of what they believed represented savings for their children instead constitutes a tax liability that must be addressed first. An important exception exists in the form of the spousal rollover provision. When assets pass to a surviving spouse or common law partner, most capital property and registered accounts can transfer on a tax-deferred basis. This means the deemed disposition does not trigger immediate taxation. Instead, the surviving spouse inherits the asset at its adjusted cost base, and tax obligations are postponed until the surviving spouse either sells the asset or passes away themselves. This represents a powerful planning instrument. However, it is frequently misunderstood. Deferral does not constitute elimination. When the second spouse dies, all deferred gains are triggered unless additional planning measures have been implemented. In certain circumstances, the combined estate of the second spouse faces an even larger tax obligation than if partial taxation had been managed at an earlier stage. Business owners encounter additional layers of complexity in this area. Shares of a private corporation may qualify for the lifetime capital gains exemption if the shares satisfy strict criteria, as qualified small business corporation shares. The exemption limit has increased over time, providing significant shelter for eligible gains. However, qualification rules are highly technical. Asset composition tests, active business requirements, and holding periods must all be satisfied. Without proper planning before death, an estate may fail to qualify and forfeit access to that valuable exemption. Another common misunderstanding requires clarification at this point. Beneficiaries in Canada do not pay tax simply for receiving an inheritance. The tax liability generally arises within the deceased's final return and is paid from estate assets. This means the executor must file the final tax return, report all deemed dispositions, and ensure taxes are paid before distributing assets to beneficiaries. If insufficient liquid cash exists within the estate, assets may require sale to cover the tax obligation. This creates practical challenges that families often fail to anticipate. A family cottage intended to remain within the family for future generations may need to be sold because insufficient cash exists to pay the capital gains tax. Investment accounts may require rapid liquidation. Emotional decisions become financial emergencies during an already difficult period. Another issue that frequently arises involves probate. In certain provinces, estate administration tax, commonly referred to as probate fees, applies based on the value of the estate passing through the will. While not technically classified as income tax, it represents another cost associated with death that reduces what beneficiaries ultimately receive. In Ontario, for example, the rate can exceed 1% of estate value above certain thresholds. Proper beneficiary designations and ownership structures can sometimes reduce probate exposure, but such arrangements must be established carefully with professional guidance. Some individuals attempt to circumvent taxes by adding children to property titles during their lifetime. This strategy can produce unintended consequences. Adding a child as joint owner may be considered a partial disposition for tax purposes, potentially triggering capital gains at that very moment. It can also expose the property to the child's creditors, marital disputes, or potential bankruptcy proceedings. Furthermore, unclear intentions can lead to legal disputes among siblings following death. Courts have repeatedly addressed cases where joint ownership arrangements created conflict rather than the clarity that was intended. The question naturally arises regarding what measures can be taken. Planning represents the essential response. The initial step involves understanding the complete asset picture. Many families have never calculated the adjusted cost base of their properties or investments. Without knowing the original purchase price and improvements made over the years, accurately estimating potential gains proves impossible. Gradual registered retirement savings plan withdrawals during retirement years may reduce account size at death and smooth tax exposure over lower income years. Strategic use of tax-free savings accounts can shift growth into a tax-free environment. For couples, thoughtful use of spousal rollovers and beneficiary designations can defer taxation or manage timing more effectively. Permanent life insurance is frequently employed as a liquidity tool in estate planning. The death benefit is generally paid tax-free to named beneficiaries. In estate planning contexts, insurance can provide the cash necessary to pay tax liabilities without forcing the sale of cherished assets. For business owners, corporate-owned policies may create capital dividend account credits, allowing tax-efficient distribution to shareholders. These strategies require professional guidance and careful underwriting considerations. Trust structures can also serve important functions in comprehensive estate planning. Testamentary trusts, created under a will, may provide control over distribution timing and protect vulnerable beneficiaries from financial mismanagement. Inter vivos trusts established during lifetime may freeze value for estate tax purposes, while future growth accrues to the next generation. However, trusts carry administrative costs and complex tax rules, including periodic deemed disposition rules every 21 years for certain trust structures. For seniors following this information, the most important message is not fear, it is awareness. The Canadian system operates transparently. The rules are published and publicly available. The outcomes are predictable when properly understood. Problems arise when families assume no tax applies or delay essential conversations until options have become limited. Communication within families matters considerably. Adult children should know whether a will exists, where it is stored, and who has been designated as executor. Executors should understand their responsibilities fully, including the requirement to obtain a clearance certificate from the Canada Revenue Agency before distributing estate assets. Failing to secure that clearance can expose executors personally to any unpaid tax liabilities. Another point often overlooked involves the fact that the final tax return may include additional items beyond capital gains and registered accounts. Unused old age security clawbacks, pension income, accrued interest, and even certain government benefits adjustments can affect the final calculation. The timing of death within the calendar year can influence total income and applicable marginal rates. For those concerned about government benefits, understanding that death does not trigger a clawback of previously received old age security or Canada Pension Plan benefits beyond standard reporting adjustments is important. The estate tax consequences primarily arise from asset values and accumulated gains, rather than from pensions already paid during the deceased's lifetime. If you are a senior homeowner whose only major asset is a principal residence that qualifies fully for exemption, and you have modest registered savings with a surviving spouse, your exposure may prove manageable. However, if you hold additional properties, substantial non-registered investments, or a large registered retirement savings plan without a spousal beneficiary, planning becomes considerably more urgent. Reviewing beneficiary designations regularly is also advisable. Registered accounts and insurance policies pass outside the will when a direct beneficiary is named. That arrangement can simplify administration and potentially reduce probate costs. But coordination with the overall estate plan remains essential. An outdated designation can override intentions expressed in a will, creating outcomes the deceased never intended. As Canadians approach 2026 and beyond, legislative changes can alter rates, thresholds, and inclusion percentages. While tax policy continues evolving, the underlying structure of deemed disposition at death has existed for decades within the Canadian system. That core principle is unlikely to disappear. The inclusion rate adjustments simply magnify the impact for those with larger accumulated gains. The essential conclusion is clear. In Canada, death constitutes a taxable event, not because the government imposes a separate inheritance tax on beneficiaries, but because the tax system treats death as a final accounting of unrealized gains and deferred income. The estate settles those obligations before wealth transfers to the next generation. If protecting your family from unwelcome surprises is a priority, begin by gathering comprehensive information. List every property, account, investment, and policy you hold. Determine original purchase prices where records permit. Consult with a qualified accountant or estate planning lawyer who understands both federal and provincial rules. Update your will to reflect current circumstances. Confirm your powers of attorney remain valid. Review beneficiary designations across all accounts. Consider whether insurance or gradual withdrawal strategies make sense given your particular situation. For many Canadian families, the difference between proactive planning and no planning can represent tens or even hundreds of thousands of dollars, not because the law operates unfairly, but because it functions mechanically. It applies consistently to those who prepare and those who do not. Canada's taxation system is constructed upon the taxation of income and gains, including those realized at death. Understanding that reality enables you to act deliberately rather than react during a crisis. Your legacy extends beyond the assets you leave behind. It encompasses the clarity and preparation you provide to those who follow you. As developments continue unfolding heading into 2026, remaining informed proves essential. Laws change, thresholds shift. However, the fundamental principle remains constant. When life ends, the tax file does not close. With proper knowledge and thoughtful planning, you can ensure that what you worked to accumulate throughout your lifetime benefits your family as you intended, without unnecessary surprises along the way.